Good day. This is HJT Views on Current Affairs. Today, we will be talking of the unfairness of the Income Tax Act with particular reference to how it is in India. We are well aware that the Indian Income Tax Act clearly does not bring into its ambit an entire class of people, which are the agriculturists. We are also aware that under the ruse of calling a lot of income as agricultural income, there is a lot of income that escapes tax. However, I'm going to discuss today on a different topic. I'm going to discuss on when something becomes taxable and how the very rich are able to escape the clutches of the tax by a very fine balancing act that they perform. We all know that salary is taxable. We all know that perquisites have a certain valuation methodology and they are therefore taxable. We also know that a simple thing like our savings, which if we have invested in the shares of a company, the dividend that we get comes from the post-tax profits of that company. And despite the same income having suffered tax once at the corporate end, when it comes into our hands, that dividend is taxed again. In my view, this is one of the greatest injustices that is done to individuals, that on an income that has suffered tax, the individual is asked to pay his income tax again, his or her income tax again. But that's not the issue that I'm going to draw in this talk. I'm proceeding further. And if you have invested in mutual funds and go through the process of systematic transfer plans, and that is weekly or monthly or whatever it is, you have a process of moving, shuffling money from one mutual fund plan to another, normally from a debt fund into an equity fund or a liquid fund into an equity fund, because you want to take some amount of de-risk yourself to some extent and take some advantage of supposed capital appreciation that happens on the capital market. Every single time that this event occurs, and that is something moves out of one mutual fund house scheme and enters another mutual fund house scheme, you supposedly pay capital gains, whether short term or long term, depending upon the period for which the mutual fund from which you have moved the amount you've been holding. In my view, this is unfair because you are not changing the mutual fund house, you are only shuffling the pack of mutual funds from one mutual fund to another, and yet that amount is deemed to be taxed because you are supposed to have gotten cash out of the transfer out, and that same cash you are supposed to have invested into the fund in which there is a transfer in. So there is a pseudo cash flow that comes in, on which you start paying tax. However, the same thing at a much higher scale does not does not apply to leveraged buyouts. I can be an entrepreneur, I can be a big industrialist. I have shares in my entity, significant value of shares. I can go to the investment bankers, etc., to the commercial banks, and I can tell them, I'm going to give this shares to you in escrow. I'm making a bid for this company, and you fund me for the purchase of the shares of that company. And that gets done. That is called the leverage buyout. That gets done. But I don't think there's anywhere a case of capital gains coming in over here. Why? Because the lender has given money not on sale, but on the shares being held by it, on the security of the shares. And if something goes wrong, he can sell the shares and exit. Fine, but is that not in the same criteria as the pseudo cash that we were getting for the STPs? Is the industrialist or the entrepreneur or the capitalist or whatever you wish to call it, who is making the bid for the company, is he not converting his shares into cash? Indirectly, directly, whatever it is. If he is converting his shares into cash, then why is it that he is not taxed? Internationally, this is becoming a big issue. In fact, I am raising this because I saw a clip of a comedian who would be charging a few $100,000 for every show that he put, but he has raised this issue. And I link that issue to the fact that for us small investors, dividend and STPs become subject to tax again. But this huge, huge wave of enriching yourself through leveraged buyouts completely seems to be completely escaping the tax net. Is that not something that needs to be viewed seriously? That if you are at all and cashing on your shares in any way, whether you receive cash or not, if that security is used as an encashment for yours, there is a conversion into cash, and that must fall into the income tax net. That ends my talk of today. If you liked it, please share it with your friends, acquaintances, relatives, etc. Till we meet again, Jai Hind, Jai Maharashtra, Jai Mumbai. Bye.